Today we're speaking to you from Athens, where we're talking to Giannis Komitas, who is a operations director of a US family office based out of London, but investing on a pan-European basis. We're speaking about all things finance and investment. We talk about Giannis's personal journey from engineering through the automotive sector in strategy consulting, along the engineering side of renewable energy on the way, to up to this point where he's now hands-on on the investment side of a large American fund. Then we'll talk through the present trends that are occurring in the renewable energy industry, things like internationalization, the space of private companies, the impacts of government regulations, the impact of Glasgow and COP. Then we'll go into the future, like what it is like to be investing at moments of uncertainty, where we're going through worlds of high inflation, lower growth, the searching for unicorns, whether that's even possible, where the sector is going, where the investment sector is going, and what skill sets are needed to really drive and thrive within it. I found it to be a very interesting conversation, and I hope that you will too. Thank you. So, Giannis, thank you so much for inviting us over here to Athens. Beautiful place, beautiful weather. Thank you for organising that as well. Lovely town square, and yeah, it's a great pleasure to be here.
Thank you very much for coming, Chris. It's really my pleasure to participate in the series. I'm very passionate about the energy transition, and we're very fortunate to be doing this in this fantastic setting, this amazing weather, and looking forward to our discussion.
Great, yeah, me too. So, could you give us a little bit of background on yourself, like how your journey to date?
So indeed, so I started as a mechanical engineer. That's my background, that's my first degree. And my first job was in the automotive sector. So I started off working in the Land Rover plant up in Solihull in the UK, and then moved on to Toyota. So I spent quite a few years in the sector, which was an amazing sector, taught me a lot. But at some point, 10, 12 years ago, I decided I wanted to make a switch. It coincided with making a change in where I was living. I moved to the UK from Belgium, where I had moved for the Toyota stint. And this is when I went into renewables. It was purely on the basis that it was a up and coming new industry. I was really attracted to the whole narrative of really trying to do something for the world. Back then, I wasn't really so much into the energy transition big picture. I was more focused on the technology, delivering those small back then little projects. Did a stint with privately owned, family office owned business that operated out of London. We did some wind, solar and waste to energy projects up until 2016, 2017. At which point I finished my MBA at LBS. On the back of that MBA, I again tried to look at some options, and this is when I went to consulting. So I joined Parthenon, EY Parthenon, the transaction team. It was all good, it was all going perfectly nice, but the pool of the renewables was always there. And since 2019, I'm back in the sector. Now I'm working again for a family office-owned business, a platform, you will, an investment platform. And we're doing wind, we're doing solar. We are trying to also start some storage projects. So the typical renewable energy asset investors.
Investments. as a subject, has been a very hot topic since the latest COP up in Glasgow. But investment in renewables can mean a lot of different things to a lot of different people. For example, the one person's view of it might be searching for the next clean tech unicorn or the first clean tech unicorn, and somebody else's view of it might be just looking for long-term stable returns with low risk. What's your take on the role of investments in the energy transition?
So the role of investment in energy transition is fundamental. It's absolutely elementary in the sense that for the energy transition to happen, you need a renewable energy generation in the first place. And that in itself, although it sounds very simple, people look at solar panels, wind turbines, and they think this is a technology that it feels like it's been there forever. It hasn't. It's only been 10, 15, 20 years. It's not that long. But what people perhaps don't necessarily grasp is that these assets need to live 25 years alongside highways in the deep seas or near towns, office buildings, parking spaces, etc. So bringing that in reality actually proves a lot more complicated than people think. So it's still something that has the traditional risk stacking. So you have the technology risk is indeed lower these days, but you have the development risk, you have the construction risk, you have the operational risk, you have the end of life management risk. So there's still, where there is risk, there is an opportunity to invest. And for sure there will be more and more demand for this generation of clean electricity. Having said that, clean tech is a much broader topic. I find it a bit difficult sometimes to distinguish what is clean tech and what isn't. Is Tesla a clean tech company? One could say yes, it is taking CO2 out of the road, but is it facilitating the transition? Yes, maybe it's up there. Now, when it comes to investor returns, so far, I think the returns follow the investors in the infrastructure. So there's been many investments in the value chain, such as in the components manufacturing, in networks, in the retail side of things, and they haven't done spectacularly well. On the contrary, the investors on the infrastructure side, they've not done extremely well themselves, but they've done well in a stable manner. So, and that's all you need to keep on the taps on the flow of money. So I think this will continue. People will still be looking for unicorns. People will still be fascinated by these very clever ideas on managing the various aspects of the energy transition. From our perspective, the companies I've been working with, they tend to focus more on the infrastructure investment side. It's a bit more boring, but it's a little bit more predictable.
Yeah, no, I'm very much involved in the infrastructure investment side too, but it's boring. I don't think I'd agree with that, though.
Yeah, I think people find it sometimes, but I agree with you, it's not.
You mentioned that your current job is working for an investment platform. Could you tell us a little bit more about that?
We are funded by a family office that is making these investments not just on the basis of the returns, but really because they want to create a revenue generation for themselves, but also they want to be involved in the energy transition. It's a US funded platform. Mm-hmm. We do work with developers. We are not necessarily fully vertically integrated in the value chain, but that is for a reason. We want to be agile in kind of identifying opportunities. Mm-hmm. Our focus is on identifying those mid-stage development assets that need a little bit of help to go to the ready-to-build stage are a little bit against some timelines, and we can then come in these situations and get those assets built. So that's our main focus. We are kind of also going into projects that we develop from scratch. So we're trying to go into storage, develop our own battery systems projects from scratch, and we're also considering offshore wind, floating offshore. It's going to be a slightly long-term bet, but it's something that we think it might worth trying to do.
So just to put things into a little bit of context now, the broader environment, how have you seen over your 10 or 15 years in the renewable energy sector, the attitude of investors having changed? Like, I can remember when I first went in there, nobody wanted to touch it. It was deemed to be, boring, no returns, difficult. You need to wait for an awful long time to get whatever paltry returns are available. I'm not sure a lot's changed in that, but people are still chasing it. So are chasing it now, which is great. But how have you seen things change?
It depends where you've been observing things from. So I have seen quite a bit of the sector in this side of the world, and it's been really a roller coaster in the sense there's been kind of big excitement at times, followed by a policy unwinding that then resulted in slight catastrophes in some cases. In my experience, funding has never been as abundant as it is now. So everybody wants to go into renewables, and it's not just the folks that you've been traditionally expecting to see there. So right now, what additionally you see is because this transformation is taking effect, the decarbonization being a board agenda, a shareholder quarterly meeting agenda, all the companies want to shift. And you see those big energy players from oil and gas coming, very big in the sector. Other industries, they really want to reduce their CO2 exposure. So you see more players that want to get a piece of the pie. That's good news for developers, but it also means that when there is too much money chasing things, then there can be some bubble territories or cases. So one needs to be very, very careful with how they approach this.
For sure. But don't you think things are likely to change now? We're in a place where inflation is going higher, where geopolitical uncertainty is going higher, where economies are slowing down. Interest rates will be going up at the same time as the economy will be slowing down. These are not good mixes for people looking to invest in long-term infrastructure projects.
That's absolutely true. There is something that differentiates the sector, and I wouldn't say it makes it recession-proof, but I think it helps a little bit. And that is that no matter how strong a recession is, the sheer irreversible scale of the energy transition, the fact that in whatever happens in 10 years, we will all be driving electric vehicles, that kind of guarantees the demand. And however, the problem is that what I'm saying to you, most people may think the same, and that means, okay, let's go and do it. And then that makes, again, the valuations a little bit sometimes difficult to swallow, therefore difficult to make money on the back of it. So I would say you look for value, you look what value you can bring in the assets, where you stand in the value chain, what capabilities you need to internalize, and how you can identify situations where you can benefit.
Okay, and like you're a good example of how investment has become internationalized in this, where you've got American investors operating out of a fund out of London, and you're doing significant investments in Greece. That's clearly a big trend in the market.
Yes. It's been a kind of a nomadic sector from the very beginning. People in the sector learned to follow the tariffs back in the day. Okay. And this is across the whole chain. So investors, construction companies, suppliers alike, they are very quick to adapt their models, move people around, deliver projects. There are people that have maintained the same advisors, the same EPC contractors and same suppliers, and work with them in various places in the world. So, but then of course, once you move, you try to see if there is any local value you can extract, you can find. I think it's because of the origins of this kind of nomadic kind of investing, yes.
And we're now entering a space where a lot of the value has been taken out of the European markets, the US markets. It's much more, the things are much more compressed. Can you see yourselves expanding into other markets, which you say that there's a lot of capital going around? In South America, in Africa, it's not quite the same. It is much more difficult. Can you see yourselves expanding in that direction?
So the short answer for the company I work with is that this is not a priority for us. So we still believe that Europe has a way to go, as does the US. So there is this big shift in demand that we will be looking to be supplying to. Now, the sector, more broadly speaking, is looking at those regions. A company I used to work a few years back, they would be a French company doing renewables in Latin America, in Brazil, or in Africa. It's something which, as we said earlier, you can bring your trade into these regions. So absolutely, yes.
Okay. Thank you. Another one of the big trends in the sector is the increasing amount, of which you mentioned earlier on, of the private sector setting their own targets, setting their own objectives, which are outside of government policy.
Yes.
Can you see that expanding, and how do you think that's impacting on the investment community?
So I think it definitely has some room to expand. The idea is relatively simple. That when it comes to the energy generation, you can benefit from a direct agreement with a generating to offtake the energy from a generating asset, and have an agreement with the asset owner for the offtake, and you will get a better price compared to buying this from your utility provider. So there is an incentive for the consumer of energy, and there is also an incentive for the seller of energy, because they will also probably sell it a little bit more expensive than they would sell to the utility provider. So corporate PPAs are becoming more and more standardized. There's a lot more we know about them now, but obviously they need to be further stress tested in more real life scenarios. So I don't think companies will go 100% on a private PPA with an asset owner, but there's still some way to go.
Okay. Yeah, that relationship with the utility company is a very difficult one to manage. The asset owner, the business, the consumer of the energy, will still, as you say, want to be having a fixed line into their premises just in case. The sun isn't shining, or the wind's not blowing. But the grid will want to be paid a price.
Yes.
It's a difficult thing to balance.
It's a difficult formula to make, but it's being done. It's being done in the UK. You have various charges that are being levied on one side or the other. There's living fees. There's ways that you can make this work. It wouldn't work if people wouldn't had not found those formulas. For me, the question is markets that have not yet developed these frameworks, and Greece is an example, whether they will actually benefit from entering this kind of arrangements late, so benefit from the already accumulated knowledge in the space, or be left behind from not seeing all the progress that, let's say, the UK policymakers are seeing. So we'll have to wait and see. My bet, my gut feeling is that those that enter later will actually benefit by accumulating or learning from the errors from other territories.
Okay. All right, so on to the next section, which is investments, the investment industry in practice. So how do you go about evaluating an opportunity, a project that comes across your desk?
So these are real hard assets. So it is a piece of land, it is a connection point. You need to evaluate the time frames, you need to evaluate the risk, you need to evaluate what lies ahead to turn this early stage development project into a revenue generating asset. It's not really a science, it's really about having the experience, asking the right questions, and trying to be fair on how you measure the risks ahead. Operating assets are slightly easier to evaluate. There's a lot of, let's say, there's a lot of track record and operational data which you can dive into and figure out where you are. But I'd say the due diligence methodology is quite established in the sector. It varies only by specifics. And this is where you need a little bit of experience, because some cases are less common than others, and you need to know what this means really for the future of the asset.
And can you tell us a little bit about your operational structure, like the people in your team, and how the various skill sets that you have and you need to have to make these projects work?
Yes. So I'd say our setup is fairly typical. The typical setup for a kind of a hands-on financial investor, i.e. not a passive investor, is to try to go into the risk stack and develop some capabilities to control that risk. So we have development managers, we have construction managers, we have asset managers. And through them, we manage the risk at those different stages. What is, of course, very interesting is the transition of an asset through the different stages, so development through to operations. But it's something that we were quite fortunate in our team. We have people that have been in both sides of the development and construction boundary, of the construction asset management boundary. So it's a good thing to have a solid understanding of those transitions in the asset life. I'd say that's quite important. And of course, we are very humble in the sense that we know we don't know everything. So we know that we will need to rely to externals. There are multiple specialist topics where we don't need to reinvent the wheel. We can take advice from external technical advisors, very specialty advisors on certain things. So it's something that the industry has kind of allocated correctly, how to optimize resources. Mm-hmm. We're not into we're not building the assets ourselves, so we don't We don't have technicians screwing the panels on the structures. It's simply because what is more efficient is to let specialized contractors do it. Yeah. So that's the model, really.
Okay, and what are the weak links that you can see in that infrastructure of the various, yourself, the investor's role, the advisor's role, the manufacturer's role, the grids? How there's a very complicated infrastructure, a very complicated ecosystem there that is required to be putting all this in place, including governmental support, including planning, including the grid itself.
Yes.
Where are the weak links? What do you, as an investor, what are you most worried about?
I think going back to what I said earlier, that these people need to understand that these are assets that will occupy somebody's land. They will need to connect to a grid, and they will need to be there for 25 years. Live their long lives on soil that may have its underground risks, or be at risk of being contaminated by human activity elsewhere, and also be subject to ever-changing rules and regulations, and some of them changing with a retroactive validity. So I'd say there's so many parameters, and you can never be 100% sure that you have bottled each and every risk. So just by the power of statistics, when 1,000 things can go wrong, one will. It's almost inevitable. You've done a good job by identifying the 999, but one can get you. Not destroy you, but it will need some attention.
How do you measure the different metrics when you're assessing the risk and rewards? Is it purely financial, or are there other considerations? For example, how much impact you're making, how much carbon you take out of the atmosphere?
So these are things that we measure, mainly because, again, it's a symbiotic kind of existence, right? So this asset will be there for 25 years. If we are imposing on people will know. Even if they don't know before we start construction, they will find out later. So increasingly, the industry is very conscious on how we're dealing with the community surrounding the assets. You want to have good relations, and because you will be there for such a short time, this cannot be superficial. You can't just do something and go. You will be there. Well, the asset will be there. The SPV, whoever is holding, will be there. You need to make sure that you treat the region, the place, the town, the municipality that is hosting you with respect. So that's something we do. This is something we know we need to keep on focusing at. In terms of whether this is a criteria for investing, it absolutely is. You won't go and invest in an asset that will be perceived as not compatible with the region. Even if you have all the license, you can't be seen as a hostile alien landing on this community. So it absolutely is part of the assessment.
Is there any weight given to the environmental impacts?
Yes.
Given in your considerations, like for example, two sites, all things being equal, except one is marginally less profitable than the other, but the one that's less profitable has got a far greater impact on taking carbon out. Which one do you go for?
So we're taking carbon out on the merit of the more solar we deploy, the more carbon we take. So I would say that the imperative is to deploy as much renewable power as possible. The focus is that, without being almost an inevitability, what the focus then shifts is how does our presence there work for the environment, work for the local community. And what we are finding is there's lots of opportunities to do or try or study new things. So we've had lots of discussions with environmental groups, academic folks that they say, look, this is a fantastic opportunity. This will be a piece of land undisturbed for many years, and just to study how it recovers. Or we have other angles that say, okay, actually this is an opportunity to improve not just the ground and the soil and the vegetation, but the fauna as well. How we bring in back animals, insects, etc. So in a way, you don't start by thinking what I can do to improve this land, but you realize there's so many things you can do. It's almost a waste not to do them. So there will be more and more of that coming our way. Yeah. Lots of land. It's a very, solar in particular, so much land intensive. It would be really a waste not to find ways of doing something good with the land.
No, it's a very, very, if I might say, kind of enlightened view of the responsibilities there. But do you think that that's because you've got additional freedoms because of your capital structure, because it's a family office and it's individually motivated people who want to take the overall good as a consideration? Or do you think that that's something that is filtering down throughout the entire investment community?
So I think you will find that many of the people in the industry, they do have a genuine interest in this kind of thing. So the community relations, what you can do for the ground you're occupying, especially those folks that are a little bit closer to the action. So if you are a passive investor with a small minority stake in an already operating asset, you might put a little bit your due diligence kind of community relation check thing. But if you're a little bit closer to the operations, to the construction activities, to the local communities, I find it's almost impossible to ignore. You literally have the opportunity to really do something good with very little. So why not do it?
Yeah, up until now, subsidies, so to speak, have been very much provided by governments. So like Germany building out massive amounts of solar, the feed-in tariffs in the UK, just all of these examples. But in the tech world, it wasn't governments who were subsidizing these companies. Like Amazon spent more than 10 years losing money every single year, but it was investors who were keeping it going, who were subsidizing it up until the point it became profitable.
Yeah.
Now, the motivations were slightly different. Like the motivations for governments are, we believe that this is an important thing for our infrastructure, for our community, for our environment.
Yeah.
The investors in Silicon Valley and around the world who are looking after Amazon weren't motivated by thinking Amazon is fundamentally a good thing, a progression for the human race. They're motivated by thinking this is going to make me a lot of money.
Yeah.
Where do you think that's in the investing community is now?
The rate in how technology changes, how easy it is to misjudge how much to invest if you are a supplier and then be caught out. So if you are an equity investor or a retail investor, it's so difficult. There's been so many high-profile bankruptcies and people losing their money. I'd say for retail investors, the biggest benefit is the energy transition itself and the very, very, very cheap energy. Now, making money in IPPs, investing in IPPs, there's many listed independent power producers. That is, I think they have quite high chances of generating dividends at some point. It is entirely possible that one day this will happen.
Well, again, with your investor's hat on, if you go back to the famous old story of the gold rush in America, the only people who made money during the gold rush were the people who sold the picks, or like who sold the sandwiches for the people going up the mountains. Who are the pick makers or the sandwich makers who are making money in this transition?
So there's many examples of suppliers losing everything, right? Simply because these big peaks and troughs, they can really wipe you out. I think here the focus should be what is most valuable here is the energy generation. I think the people that make money are those that are closer to the kilowatt hour generation.
Yeah. Although in any particular part of the world, there'll be their technology of choice. So here, it's likely to be solar. In North Sea, England, it's going to be wind. When the wind blows the North Sea, everybody's value goes down.
Yes.
Here, when the sun goes, everybody's solar value goes down. So being close to it kind of implies maybe it's the energy storage people, the guys who can hold on to it and put it into the grid at a better time.
That's a very good point. That's a very good point. But you are right. The storage, technologically, it still has some limitations because it's only very short-term storage. But it is happening as we speak. Storage asset owners in the UK are making really good returns, balancing the market and offering ancillary services in that particular market. So it's definitely happening. Will it happen forever? Don't know, because again, the more storage you have, the less imbalance you have, right? So in a way, it is the nature of our sector. More capacity, more. Lower prices.
Yeah. And what does storage mean to you? You seem to be just talking about batteries, but there's more.
Yes. So it is batteries for now, in the sense that this is the most readily available systems out there. I think the next is hydrogen, generating green hydrogen, which again it's something which we need to see how it will be consumed, okay? But I think that's coming right next to it. And then there's niche or very specific cases of storing energy in all possible ways you can imagine. I have to admit I'm not very close to any such creative projects about moving water between heights or
they're good projects. We should talk.
They are. Well, I'm sure they are. They do make sense. They are extremely specific, but I am a big fan of battery storage, in the sense that now it's so well engineered. It's so easy to deploy. You don't have the constraints you have from solar, for example. It's much less energy intensive. You don't need to follow the resource. You can, it's a little bit easier to deploy in that sense. And yeah, I've had very good experience deploying storage projects.
Yeah, batteries as a technology are fantastic, and they're improving all the time. The main problems I'm seeing with batteries at the moment are increasing costs, increasing scarcity, longer lead times. Everybody wants to do batteries, and it's pretty hard. I know, and you've now got your 8-hour batteries appearing in California. Mm-hmm. Yeah, that's a big step forward. But we're still a long way away from the 100-hour batteries that we're probably going to need.
Yeah, no, that's true. That's absolutely true. I'm not sure how long it will take, or what will that mean for supply chains, both in materials but also in moving the equipment around. But guess what? I mean, solar was some years ago 80 times more expensive. People were thinking it's impossible to achieve the kind of volumes we're seeing in the last few years. So
true, but solar is also getting more expensive.
It is getting more expensive indeed.
Yeah.
But so does energy.
Yep.
The end product. I think it's all part of the transition. It needs to be managed, because energy is you can't live without energy. But I think what you see all around the world is governments do step in. and try to regulate that a bit more.
Yeah, interesting comment. You can't live without energy. I think we're from an extremely blessed generation. Like it was ourselves, our parents, maybe our grandparents, the first generations in history that haven't had to worry about energy.
Yes.
We're sitting here thinking, oh, energy. Of course, it's an absolute right. But for thousands of years of human history, this was not the case. It was something that people were deeply concerned about.
And we're a little bit concerned now. But I think we are on the cusp of really reaching a point where energy will be generated anywhere and everywhere. Technology will close all these big questions around materials. Or there's so many ways to generate energy once you move the model away from the fossil fuels, moving fuels all around the world. I mean, if you look at that, how absurd is that, right? So the kind of adjustments we will need to make for the renewable or green energy transition, they are nothing compared to this insane infrastructure and what we've been doing with fossil fuels, right?
True, but there's a lot of vested interests who wish to be keeping up the status quo. So
yeah, I think there will be a moment in time where this will have enough momentum to.
We'll hope so. We'll hope so. That's a transition, but to get there, we'll also need other mechanisms. So, for example, one of the reasons I was asking you about, do you look at the carbon that you're taking out earlier on, was do you see a future for where carbon is going to be a cost, like a liability in your
yes. No, we're seeing this now. I'd say the most motivated buyers out there are those that have the most offsetting to do. So it is happening, even if it's not 100% clear, or the mechanism at this stage. The writing is on the wall. I mean, carbon is a liability, and anything you'll do to mitigate that, it's something you better do it.
And speaking of the vested interests, so like for example, like the incumbent energy providers, the big oil and gas majors, you mentioned earlier on that they're playing an increasing role in their transition themselves. They're putting a lot of investments. Do you see a natural fit for like your BPs, your Shells, your Aramcos getting into that space, or not?
So that has been the big debate as to whether it's the utilities or the energy companies that are better suited. If you had asked me a few years ago, I'd say probably the utilities probably are better because they understand electricity better. But the reality is, I think, the threat to the oil and gas sector is such that they've really pushed a lot. So they're really now spending a lot of money, building up teams, getting people in, and I think they are definitely very strong in coming into the renewables big time.
Yeah. Well, their main advantage is, of course, balance sheet. You know, they've got a tiny cost of capital compared to.
They have low cost of capital, and in a way, they, as I said, they're very motivated to at least try to do it, right? So, not all of them, but many are.
All right. So we just got a couple of questions that always ask to all the interviewees. First is, for all the people who are kind of watching this and listening to this, could you answer the question of why they should care about what you care about? Why, like you're clearly very passionate about the space you're in, about being into renewables, but particularly into the finance part of it. Yeah. Why should I or an LBS student looking for a future, or someone as an investor, be putting their time, their money, their careers into investment in this space?
I'd say it's a very exciting sector, and not just for the professions you name. I think people interested, in general management, project management, all sorts of skills and backgrounds. It's a very fast evolving sector, meaning that there's not a lot of people that have tons of experience, and therefore you feel you have a huge gap to bridge. It's something where you can come in, learn, and kind of follow the flow of things, and it has a long kind of stint of time ahead, meaning that you can even switch into the sector coming a little bit not early in your career but a bit later. I've seen people coming into the industry looking to prolong their careers, and I guess there's lots of things that fit well for people from different skill sets, moments in their careers, etc. You can transfer your skills. I had a procurement background in automotive. I came and started a career in renewables. I had people I know from LBS, from elsewhere, that they went into renewable energy finance, not coming from this particular asset focus, and they've done very well. It is a growing sector, hence will give the opportunities, and it's very evolving, hence will give the interest.
Mm-hmm. And from a slightly different perspective, seeing as you've got an engineering background, yeah. Why would engineers want to be getting involved in this as opposed to the IT space, the tech space, which everybody seems to be driven into at the moment?
Don't get me wrong. I won't say that it's the best sector to be in. What I will say is that because it is growing, because it is changing, and changing in terms of technology, changing in terms of business models and all that, it means that you'll get opportunities to transition. So I've seen lots of engineers coming and kind of growing into general management. So it's something you can do in renewables. You accumulate the knowledge through projects. All of a sudden you find yourself managing multiple projects. You then find yourself managing a team of project managers. It is not unlike tech, but I'd say if we say renewables is as good as tech, that's probably good enough.
That's fair. All right, and last but not least, we're here in Greece, here in Athens. Wonderful place, and making some strides towards the renewable transition. Otherwise, you wouldn't be sitting across the table from me right now. What lessons can be learned, for good or from bad, from the Greek experience of renewables, of the transition of energy policy?
Lots, or very few, depends how you look at it. I'd say Greece followed the typical kind of early market challenges. So we had a policy that was running too hot. We then had to pull the handbrake. We didn't kill the sector, but it suffered a lot. But this is where I'm saying that just the sheer transition makes the sector almost recession-proof, even in Greece. Even with the pay policy failure, even with the debt crisis, the industry is coming back. It's coming back a big time, simply because Greece needs to cut its reliance on lignite, which is a kind of a poor type of coal that is really polluting a lot, with lots of CO2 emissions, very inefficient. And because we have to move away from it just to control our emissions, and because renewables are now so efficient in terms of costs and output, the shift is dramatic, I'd say. So there's been peaks and troughs. There will be a sustained growth for the next few years until we manage to close down those lignite factories. So I think it's definitely, you know, you have the classic policy errors we made, but I'd say, you know, trust the power of the transition, and it will come through. I mean, even for Greece.
I know in Portugal, famously, there was a very generous feed-in tariff that ended up being pulled because it was unaffordable during the financial crisis, and it caused huge amounts of pain in the industry. Like it's something ridiculous, like 80% of the people involved in that industry went bust at the time. You also see kind of similar mistakes, although not quite as dramatic, in the UK, where, in my opinion, mistakes, and others may disagree, where kind of onshore wind hasn't been supported for an awful lot of years, and continues to not be supported, in despite lots of good reasons for it to be. You say put faith in the industry. Why is Greece then special that you should be putting faith in, where we're not seeing, for example, any onshore wind being built in the UK because of policy?
Well, it's not unique in any sense, okay? But it has a few things going on for it. Good sun, but also the wind, the load factors are quite good. We have lots of mountains in the country, which really gives really good wind resource. So in that sense, it has this going for it. It has things against it. So, you know, it's an archipelago, Greece. Not all of it, but there's many hundreds of thousands of people living in remote areas, and they need to be interconnected. So there needs to be some consideration for this. But I'd say what Greece has for renewables is that it's coming from a very CO2 intensive, dirty, lignite-based energy generation, and it needs to find something that is clean, cheap, and guess what? It will be wind and solar. So there is this big need to move away from that.
But is that reflected in policy? Is that reflected in? Okay, and how is that being promoted?
I'd say it's not reflected directly in the policy. I'd say it's reflected in the outcomes, in the results. So at the moment, the amount of solar and wind that is being built is really a lot. This is probably not super correct, the number I'm giving you, but it's 1.5, 1.6 gigawatts a year. Which is absolutely massive for a country that, when it was relying purely on fossil fuels, the installed capacity was 12, 13, 14 gigawatts of fossil fuels, right? It is happening, therefore things are working. I can't tell you everything is perfect, it's not. But the market is delivering capacity, yes.
Mm-hmm. Okay, so it's a triumph of capitalism over regulation, over policy.
Yes, and if you're persistent enough, and if you're willing to ride certain things out, then yes.
Well, thanks very much. Seems like a very good place to leave it. That's been
Thank you very much.
Fascinating conversation.
Absolutely loved it.
Yeah.
Thanks a lot. Cheers.
Well, thank you very much for joining us on that conversation. We hope that you enjoyed it. We hope that you learned something. If you did enjoy it, please feel free to leave a 5-star review and to subscribe to any of our channels, and we'll be sure to keep you updated on future productions. This series is produced by United Renewables in collaboration with the London Business School Alumni Energy Club.